for austere times got around judging by the lavish hors d'oeuvres outside. But don't worry, we're going to be saving the pits from the olives and use those at the next session. My job today is merely to, I'm Mike Moritz, for those of you I haven't met, is to introduce three people to you. And our hope is that this isn't too didactic a session, but what we've tried to do is to bring three different sets of experiences to at least chat and offer you our views of the circumstances as we see them today. And obviously, we have a particular agenda in mind, but all we can do here is to inform you of what we see in our immediate surroundings and in the world about us, and then obviously implore you to do what you feel is the right thing for your company, but the choice obviously is yours. I only have one visual. You'll see a lot of visuals this afternoon, but we had somebody who was asking a little earlier whether we'd ever had a similar session to this, and we did have a much smaller one without such august speakers as we'll have today. When the dot-com boom exploded upon us, and I have a picture of what happened to the one company that didn't take heed of the massively changing circumstances around it, and I wanted to take you down a trip down memory lane and show you this one visual. And it is this. But there are other people here who actually were born in very difficult times. We have visitors this afternoon, for example, from both eHarmony and Zappos, both of which were unable to raise venture capital money during very straitened circumstances. Mika Salmi, who now runs MTV Networks for Viacom, at the time was running, and he's in the audience, was running a company called Atom Shockwave that at its peak had a head count of 330 people, which after not too much deliberation, he cut to 35. And as a result of doing that, and doing that very quickly, was able to salvage a company that he eventually sold to Viacom for $250 million. So our only message, I think, is that with the right approach, with the right spirit, everybody can emerge from these circumstances in far better shape than we actually are today. But if we hesitate or enter a state of denial, life is going to be pretty cruel. So we have three speakers today, and I will introduce each of them. The first is Eric Upin, who runs Sequoia Capital endowment management business. And previously he was the chief investment officer of the Stanford Management Company, which is the entity that manages the $20 to $25 billion that Stanford University has got deployed all around the world in all sorts of different assets in developing countries and developed countries. And Eric will give you the overview of what's happening around the world and to show the ripple effects of everything that we've been bombarded with and deluged with recently. And then we'll turn to Michael Beckwith. Michael is our partner who is responsible for running our investment efforts in the public markets. And he has a whole bunch of examples of the way in which some of the really well-managed public companies hesitated the last time around, and the consequences for those who hesitated. And finally, our star turn, fresh from teaching in the Advanced Management Graduate Program of the University of Milan, Professor Douglas Leone. And Doug's going to talk about the sorts of things that we've seen go wrong in companies in which we've had investments before when we haven't collectively reacted quickly enough. So first of all, here's Eric, and he will then introduce Michael, and Michael in turn will introduce Doug.
Michael, thank you very much, and thank you all for coming today. With a day like today, with the S&P 500 down over 5%, and as we now mark levels that were last seen in 2003, one of my favorite Wall Street sayings, not my own, comes to mind, that it's always darkest before it's totally, completely pitch black. And that might be apropos for now, but in all truth, the market inhales, the market exhales. There are very long cycles at work in the marketplace. We're going to try and outline and describe a couple of those, and recognize that the key in times like this is to survive the mountain blizzard that we're currently in. It's all about surviving this incredible storm to be able to capitalize on some tremendous opportunities that will come on the other side. What we're going to try to do today is answer the question of how did we get here. This is an extraordinarily complicated problem. It is extremely hard to explain just in answering the question at the crime or accident scene, what happened. What we get asked all the time, and what we spend a lot of time trying to fully understand, because it's important to understand these to be able to diagnose what to do and how to invest in this. How did we get here? How could it be this bad? How could institutions like Bear Stearns, the largest and world's largest insurer like AIG and Lehman Brothers, disappear overnight? And that's just one of many mighty fallen heroes that have survived the Great Depression and all of the other calamities in between. How could the U.S. government have $40 to $60 trillion of unfunded liability with almost $10 trillion in current national debt? How could $700 billion be only a drop in a bucket and probably not nearly enough medicine to address the problems we have? And lastly, how could this all be at our own hands? This is not a foreign influence that did this. This is to ourselves. These are extremely complicated questions to answer, and what I'm going to try and do in the next 15 minutes is at least answer some fundamental building blocks as to why and what is the magnitude of these problems. So when you have a problem like we do, it is usually a combination of factors. It is not one single thing. But what we have now is a combination of housing-led recession and a material housing decline. Now over 40% of all home mortgages that have been issued in the last 5 years are now underwater. We had substantially over-leveraged financials. We have falling asset prices today. We have frozen credit markets, a very weak household balance sheet, which is an important factor moving forward, which Michael Beckwith will talk about. We have an explosion of derivatives that were designed to try and create protection against some of these things, since everyone knew that there was quite a party going on. The police may come, and it would be good to take protection against it, but some of those insurance products did not work out. We have a global deleveraging before our eyes, which is now creating the non-economic selling of many assets as you're trying to raise capital and lower your exposure. And at its most fundamental level, the forces of inflation are going to be battling the forces of deflation over the next 10 years in our view. The deflationary forces are the destruction of wealth, the decline of money supply. So when Merrill Lynch and all of these firms write off large portions of assets in their balance sheet, that lessens the amount of capital they can lend against those assets and therefore reduces money supply, and deflation as a monetary phenomenon. The forces of inflation is the Fed will be the lender of last resort. They're going to print as much money as they can to get us out of this problem. And it's very hard to go through a toll booth at 200 miles an hour. So the odds of getting one side wrong is very great. And that is, at its most fundamental level, in our view, what we're encountering is we see asset prices fall, wealth destroyed, versus the creation of lots of cash to try and fix this problem. When we look at the kind of problems we have with this many factors, it's important in our view, and one of the key messages we're trying to convey today is we believe we're at the beginning of a long cycle that when you look at secular trends versus cyclical trends, cyclical are generally 3 to 5 year phenomena, whereas secular are more 15 to 20 year. Markets actually move in very long periods. We lived through many of these from 1966 to 1982. That was a very, very sharp bear market. It looks flat in this graph, but actually your real purchasing power declined over 50% between 25% decline in the Dow and about this, roughly the same amount due to inflation during that entire period after you include dividends. Then we saw the greatest secular bull market of all time from 82 to 2000. And now we're in a period, in our opinion, of another secular bear market where we are now already well below levels that were achieved in 99 and 2000. So with the fundamental drivers of this, and it's very hard to actually determine what was the actual cow that kicked over the lantern that began the Chicago fire, but our view is it's these three factors were the root causes. The first is 1 billion people entered the workforce. Through restructuring and other openings of China, India, and other parts of the emerging markets, we started to see a much larger global workforce that kept a substantial amount of downward pressure on wages. The combination of this workforce entering the marketplace and the cost differential of that labor created massive productivity gains. So the middle chart really shows from a combination of technology, outsourcing, improving education of the workforce in the emerging markets, really resulted in some of the greatest productivity gains we've seen. And thirdly, significant central bank easing. What this resulted in was very low inflation and very low levels of debt cost, very low levels of interest rates, and massive liquidity. In fact, what the Fed discovered, particularly in the Greenspan administration, is almost no matter how much liquidity you put into the system, you just couldn't budge inflation. In fact, many viewed inflation as dead at that point, and that created a massive amount of liquidity in the market. And what that massive amount of liquidity created was a huge amount of spending by U.S. consumers. We're a nation of consumers. If there's one graph that is perhaps most disturbing, it is this graph. This is the U.S. current account deficit graph. We are now down to 7% of GDP. If the world's currency reserves were not denominated in U.S. dollars, we would have much greater dollar risk. We still have dollar risk, but most nations are treated quite punitively when you start to spend $1.06, $1.07 for every dollar you make over very, very long periods of time. This current account balance is one of the big outcomes of everything we've seen. The driver was this cycle. What we had is this overspending, buying goods, consuming goods overseas, particularly from Asia, essentially sent dollars to Asia. Those dollars from Asia were brought back into the United States to buy treasuries. Buying those treasuries kept the long end of the curve down, which was the Greenspan conundrum, if you remember when we had a flat rate curve. It kept interest rates very low. And when rates are low, everything is cheaper. You can buy more of it. You can finance more of it. You can handle the payments. And as a result, all of those dollars in treasuries started the cycle again. You could take out more debt, buy more goods, send more goods to Asia, and then keeping additional downward pressure. The result is this, which is what we're facing today, which is why we think this will take quite a bit of time. This is the total debt as a percent of U.S. GDP. And as you can see, it is now above what we saw in the 20s and 30s. This debt and the leveraging of this debt is one of the things that we see. Debt problems are much different and take much longer than equity problems. Equity bubbles can correct very quickly. There's relatively open and fluid markets. Debt markets, housing markets take a lot longer to clear out and to clean up. And as a result, this is going to be a drag, in our opinion, for quite some time. What has happened with this overconsumption of the U.S. consumer and the current account balance is this condition, which is also a concern, which is that we are dependent on the kindness of not only strangers, but foreigners, because now foreigners own more than 50% of all U.S. Treasury obligations and own almost 60% when looking at the full spectrum of U.S. GSA debt. So the consequences of this bring a risk that we have not yet seen. The risk we have seen is decline in equity markets, decline in debt, decline in housing, and financial system systemic risk, which is still not resolved and addressed. This presents risk to the dollar because the U.S. requires 80% of the world's available capital to finance its deficits. And if in the event we are not able to attract that capital, we will have significant upward pressure on rates or not be able to finance the way we are currently living. So we are very dependent on foreigners coming in and purchasing our securities. So with all that pleasant backdrop, here is what happened. We saw a huge flow of this liquidity into the housing market. A, partly due to policy and regulatory change starting in the 90s to increase home ownership in the U.S. B, because of the low cost of capital. And C, once you can start making money and you have strong demand in the marketplace and consumers can see that you can buy a house and make 20% a year on it, you will only pull in more consumers, more buyers, and then the leverage only starts to build. So from 2002 to 2006, a combination of all those factors resulted, as you can see in the chart, a 15-fold increase in subprime and Alt-A mortgages. What also happened during that time, which is unprecedented in U.S. history, which is what we study in the endowment business, is we look at mean reversion, we look at general long-term trends. There's never been a period where you've had this kind of growth in housing prices. We've never seen this decline in the affordability index. And housing in general has resulted in about 1% a year real over its history in the United States. And if you lever it 5 to 1, 4 to 1, you're going to get roughly 4 to 5% returns above inflation. Not a bad return, but housing is a levered return. Here you can see that we were well outside the boundaries of the mean, and obviously we believe we're going to be seeing mean reversion, and there's quite a long way to go, as you can see by the graph, until we achieve that mean reversion. But this is where a great deal of the liquidity flowed and where things really began. Because housing was going up so much, people were making so much money, you started to see the compounding factors take place in a relatively unregulated markets or in non-bank entities or off exchange kind of transactions. We saw the growth in securitizations. We saw the pools of mortgages get put together in packages where you'd had sophisticated PhDs run models on the risk of these packages failing. And if you took thousands of mortgages from thousands of locations, because there never was a synchronized U.S. housing recession on record, you could take all these packages from different kinds of mortgages and geographies, and you could call them AAA. And you could get 6% to 7% returns on a AAA pool called a CDO or a CLO, and your cost of capital was 3%. So you could borrow at 3%, make 7, lever it 4 or 5 times to 1, make 20% a year on AAA securities versus treasuries at 4. So what we saw was not only leverage on these structures, but we saw banks take on these structures and lever them up as well. So we saw leverage in the structures, leverage on the bank's balance sheets. The rating agencies misrating many of these. And if you recall, ratings agencies are not working for you, the buyer of the bonds. They work for the issuer of the bonds. And we saw the repeal of Glass-Steagall and a number of regulatory changes encouraging home ownership. Because there was such leverage and because there was such exposure, the quant models clearly pointed to some dark conditions if everything unwound the wrong way. So you saw the spike in derivatives where you could buy insurance, credit default swaps, and other products to be able to hedge, leverage, and try and transfer some of your risk to other parties. And the view was that risk was offset across so many institutions that even though there were a lot of derivatives, they all would counter and balance each other out so that the exposure any one institution had was relatively small. Because there was high confidence in these insurance products or derivatives, we saw institutions lever their balance sheets 20 to 30 to 1. So if you have a balance sheet levered 30 to 1 and your assets go down 3%, you've lost 90% of your equity. You can go in the market and try and raise capital from sovereign wealth funds. You can do that once or twice. And then if it goes down another 4 or 5%, you've wiped out all the equity again. That is how a Bear Stearns, a Lehman, with a very proud history, can disappear in a very short period of time. This is also a concern because these derivatives don't trade on unregulated exchanges, so it's very hard to know the full extent, but there are over $500 trillion of these. The U.S. economy is a $14 trillion economy, and this is why, whether the Treasury knew it or not, by letting Lehman fail, it brought down the world's largest insurance company in the world, AIG. One of the other problems with credit is that when money is cheap, times are good, returns are high, and and success is easy, you see a real ramp up in the build out of housing and all other infrastructure. This is one of the problems that occurs in a credit bubble. We saw it in Japan, we saw it in the U.S. in the 30s, we've seen this in the developed world a number of times. It creates excess capacity, and this is a chart that just shows the percent of world fixed investment as a percent of GDP, which can be a real drag on future growth for quite some time to come. So where we are today, we've all seen the equity markets, we've all seen what has occurred over time, but I think the most interesting set of numbers are the credit market. And in my view, has always been the credit market's really where the smart people are. The equities are often there's a lot of gut feel, and there's a lot of future modeling and projections. On the credit side, you're really working with hard, cold numbers, hard, cold balance sheets. The chart on the right is the spreads between investment-grade bonds and treasuries. Chart on the left is high yield or junk bonds. As you can see, the high yield market's about where it was in 2002. On the right-hand side, we are seeing corporate spreads from the Procter & Gamble's, Gillette's to smaller, trading at the highest levels ever in history. That's almost an Armageddon pricing. Or from an endowment perspective, maybe an interesting time to start looking at things, because this is where we're seeing a lot of stress. What's really interesting now is because everyone's levered, because everyone's scared, because markets are frozen, if you need to raise cash, you have to sell quality instruments. You cannot sell the junk, which is the left side. So what's happening is the quality is trading below the junk because it's the only way you can raise capital in the marketplace because they're frozen, which is why we're seeing those spreads blow out, which just intrigue us. And maybe a good opportunity, but we'll get to that in a second. We've all heard about Japan. I think it's just important to note Japan was a credit bubble. It was not a stock market crash. Yes, the Nikkei hit 40,000 in December of 1989, only to fall down to 7,200 in 2002 and is now at 10,000. Japan had a huge real estate buildup, but Japan was a little different. The corporate balance sheets were levered. It was the corporate sector, not the household sector, not the housing sector, but it still affected all of the economy, and you can see this has been a 20-year problem for Japan. Different than the U.S., but a 20-year problem due to credit buildup, and Japan performed a lot of rescues themselves. U.S. is taking more action than Japan did, but it is instructive to see what can happen to equity markets, to growth rates, and to interest rates. So lastly, in closing, our key themes that we'd like to suggest is this. Every once in a while when you assemble an army of Napoleonic proportions and it starts to snow in Russia, you got to ask, is this the big snowstorm, and do we turn back or do we just march right on? And most of the time the answer is march right on, especially because you're not going to stay a general very long if you keep turning around at any snow flurry that you see. And then every once in a while you say, snowstorms in Russia, not good for Napoleon, not good for the Germans, probably a good idea to wait till spring. In fact, wait till the summer for the muddy roads to harden up. We see this as taking quite a long time. We see this as global. We see this as secular. We do not see this as a normal, everyday thing that can be fixed with a good night kiss and a nice story. This is credit-driven. This is not equity-driven. The credit side is the bigger problem. It's harder to get your arms around, and a lot of it is off-balance sheet. We think this results in significant risk to growth and wealth and quite a number of regulatory reforms. So in closing, the only thing you can do, in our opinion, during this time is manage what you control. Even when we think about managing the endowment for Stanford or the product that we're building, you can't control future returns. You can't control inflation. And most of these are completely unknowable. You can control your spending. You can control your savings rate and your contribution rate. So our view is manage what you can control. Don't trust your models. If you noticed in the state of California today, they're having to reconvene because the entire budget, which took months to get done, turns out it's already substantially behind because all the assumptions in that budget are proving to be wrong. Revenues coming in much lighter. So whether it's revenues, costs, growth, earnings, I would take a drastic cut to those in my personal opinion. Focus on quality is really in the area of debt, in the area of relationships, in the area of any ownership or investment risk. You really want to take on quality at this point and think it's really wise at this point to reduce risk and keep debt levels extremely, extremely low. So on that note, we're going to try and move from what happened and how did Wall Street create this problem to what are the impacts on Main Street, on companies, on earnings, and on consumer behavior. And Michael Beckwith is now going to take that area.
Thanks, Eric. If I were to give a safe harbor statement, I might point out that historically I've concentrated on equities, not credit. So you may want to keep that in mind when you listen to my comments today. With the macro and secular backdrop set, I wanted to turn our attention to some of the roots of the problem on Main Street and how it's bleeding into the markets in which you operate. Over the last several decades, as the U.S. economy has shifted from a production-based economy to a services-based economy, the consumer has become the engine that truly powers the nation's economic growth. To put this in perspective, consumers now represent 73% of GDP, a 700 basis point increase over the last 20 years. The net of this is that so goes the health of the U.S. consumer, so goes the health of the nation, which, as we will see, has pretty significant implications today. At the end of the day, the current crisis started and will likely end with housing, plain and simple. The origins of the housing bubble will be debated for years, with reasons ranging from greed to ridiculously lax and sometimes predatory lending standards, with anyone with a heartbeat able to get an arm, with Greenspan reinflating the American economy with 1% Fed fund rates that stretched far too long, to public policy gone bad, with HUD and the Community Reinvestment Act effectively mandating that Fannie and Freddie target 50% of their mortgage financings go to borrowers below the median in their area back to 2000. The outgrowth of these actions was an unprecedented rise in home ownership in the last decade, with 69% of Americans owning houses at the peak, up 500 basis points from historical averages. This, coupled with Eric's data that housing prices appreciated at an 8% CAGR from 1998 to 2006, created a lot of paper gains for home ownership and a significant consumer perception of wealth creation. As these slides indicate, underneath the veneer of rising home prices, however, was an American consumer that was losing any real buying power and whose savings were plummeting. Over the last year, with core and non-core inflation on the rise, growth of real and after-tax wages and salaries has effectively been nil. To put this in context, the average household now earns $1,500 less than it would have if wages had kept pace with inflation, or roughly 3% of total household income. Not surprisingly, as Americans' real after-tax wages and salaries petered out, we saw personal consumption expenditure start to roll in 2007. The spend till you drop culture in the U.S. has also bubbled down in the personal savings rate, which we have witnessed a very disturbing trend that the U.S. households are consuming to, or in some cases below, what their after-tax income allows them to do. We're not the first to observe that the personal savings rate today is at its lowest level since 1933, providing the U.S. consumer very little cushion to absorb any economic shock or dislocation. Not surprisingly, in a spend now, worry when it's too late type culture, we have seen consumer debt service levels explode to record levels. Both the household debt service ratio and the household financial obligation ratio peaked to record levels exiting 2007, crossing 14% and 19% respectively, way above historical trend lines. So in an environment of modest wage growth and rising debt obligations, where did consumers turn to fund everything from tuitions to plasma TVs to debt obligations? Where else but their house, in the form of mortgage equity extractions? As we came out of the last recession and saw an unprecedented level of home price appreciation, as Eric pointed out, mortgage equity extractions, or MEWs, became a key engine fueling the growth of personal expenditures and the U.S. economy. Here's where the feedback loop of rising home values comes full circle. Rising home values resulted in increases in mortgage equity withdrawals, which sustained personal expenditures in a period of very, very limited wage growth and increasing debt loads. MEWs totaled $500 billion in 2006 and close to $300 billion in 2007. Assuming that two-thirds of those equity extractions translated into personal consumption expenditures, mortgage equity withdrawals accounted for 43% of the absolute GDP growth in 2006 and 33% of the total in 2007. Equally, if not more important than the virtuous cycle we saw in the early part of the decade, is the current downward spiral set off by the collapse in home prices, which are currently down close to 16% nationally. Across Main Street, starting in calendar year 07, we saw a wave of adjustable rate mortgage resets that led to a rise in mortgage delinquencies, producing unwanted and unexpected supply in the housing market, resulting in a drop in home prices that led to a decrease in mortgage equity withdrawals that ultimately led to a reduction in consumer spending, which produced a weakening job market, and now credit markets are entirely frozen, which further amplify the downward pressure of these forces. If anyone questions that we're in a recession, they won't be for long. Consumer confidence is touching recession levels. Non-farm payrolls declined 159,000 in September, the weakest since March 2003, which puts the cumulative job loss this calendar year at 760,000 jobs. The ISM Manufacturing Index plummeted to 43.5 in September from 50 in August, the lowest reading since October 2001. And current consumption growth is tracking to negative 2.5% annualized in Q3. This is the weakest reading since 1990. So what are we seeing in terms of the impact of corporate earnings? Predictably, as in past recessions, we are seeing the steady march down of earnings estimates across industries, with earnings estimates down 19% from where they were a year ago, which compares to 25% in each of the last two recessions. Apparently, the only people worse at predicting a recession than the American consumer is Wall Street. Doug will touch on this in a minute, but our belief is that a V-shaped recovery is highly unlikely, and the market appears wildly optimistic about the slope of the recovery in 2009. Currently, consensus estimates are calling for consumer discretionary spending earnings to improve 41% in 2009, media earnings to improve 11%, information technology earnings to accelerate from 10 to 17%, and total S&P earnings to improve from 1% to up 23%. Whether the current downturn we are facing is more structural in nature, that is to say much more prolonged, a la the 1970s and 1930s, or is more cyclical in nature, like the recessions of 01 and 02 and 91, I find anything but a very harsh operating environment in 2009 very difficult to imagine. On many levels, this downturn feels very far removed from the Bay Area, which is in stark contrast to 01, where we led the economy into the recession and everything from engineers to reservations at your favorite restaurant were aplenty. That's why I think it's worthwhile to spend a few minutes pointing out that this downturn already is impacting many of the core markets that many of you operate: advertising, e-commerce, mobile, and enterprise. Take advertising, for example, which always has been highly correlated with GDP. As in past recessions, the total ad market is comping negative year on year. As consumers retrench, so do the advertisers that try to reach them. We've seen a predictable pattern as it pertains to the hierarchy of advertising efficacy, with newspapers seeing the greatest declines, followed by radio, magazine, TV, branded internet, and now finally paid search. Like I'm sure most of you, I strongly believe that internet advertising is a much more effective channel to reach consumers than offline channels. But that said, it is not immune to a slowdown. The data cited in the chart above shows sub 10% growth for internet advertising. To point out, that does not include paid search, but the point still remains valid that we're seeing a meaningful deceleration in internet advertising. Volumes, CPMs, CPCs are all coming under pressure, and this I wouldn't expect to relent anytime soon. Not unlike advertising, e-commerce is a channel that fits within a broader retail economic landscape. As consumer expenditures decline, retail across channels is negatively impacted. Given that e-commerce growth has grown at a much faster rate than other channels, it has a lot farther to fall, and just in the last couple quarters, the growth rates have been cut in half from close to 20% to under 10%. As eBay's pre-announcement and reduction in force yesterday is evidence of, Cuts are now just beginning to start, and I would expect them to accelerate in the months to come. Well, Ford doesn't need to buy banners on Yahoo, and Mew-endowed friends have nothing left with which to fill their PayPal accounts, and John Doe will have to put on hold his dream 50-inch LCD TV from BestBuy.com. One would think that smartphones and iPhones would at least come to save the day. The answer is partly yes, partly no. Phones in the wireless market are equally wrapped up in the downturn, with new handset sales turning negative in the U.S. and total subscribers flattening out at roughly 5% growth. On the flip side, many of the Sequoia companies that focus on mobile, AdMob, Loop, and others, are focused squarely at the heart of the market poised for explosive growth, data usage. Data ARPU has gone from 15% of domestic ARPU to the low 20s of domestic ARPU today. This trend clearly will accelerate as voice transmission becomes increasingly commoditized in the years to come. That said, the central point holds true. The mobile market per se won't bail you out, since it will increasingly be under pressure. Only those companies that capture an increasing percentage of the highest growth segments of the mobile market will continue to flourish. Lest anyone thought this cycle was solely a consumer phenomenon, think again. While the origins of this recession clearly rest with the consumer, the implications will be felt across enterprises large and small. While the pullbacks in consumer spending are typically felt at the front end of a downturn, enterprise IT spend deteriorates later in the cycle. Case in point, the correlation with technology spending and year-over-year changes in operating earnings on a coincident basis is actually relatively immaterial, but the correlation is really tight when mapped against S&P earnings with a 2-quarter lag. If past trends persist in the U.S. economy, I would certainly be on the side of betting that the Q4 of this year and the first half of 2009 shows a meaningful deterioration in enterprise spending across the board. Even bracing for what's ahead, it's clear we've already started to see some of the signs, with PC growth in Western Europe and the U.S. cracking, and with a range of enterprise bellwethers highlighting caution in recent days, including SAP yesterday, which pre-announced, noting market developments of the past several weeks have been dramatic and worrying to many businesses. These concerns triggered a very sudden and unexpected drop in business activity. SAP may be in the early signs of a slowdown, but it won't be the last. With all the talk about the global demise and the potential impact on your business, I thought it would be worthwhile to close my section first with a round of tequila shots if Dempster is around, and secondly, and more importantly, 2 anecdotes which serve as a powerful reminder of the positives that can be accomplished in a downturn. Let's look at Buy.com and Amazon.com. Both entered the recession with astronomical growth, but followed very different paths through and after the storm. As economic conditions worsened, quality of business model and differences in value proposition were magnified. The weakness of the Buy.com model, you may remember it, sell items below cost and make up the losses from, quote, the sale of advertising and ancillary services like warranties and equipment leases, end quote, became evident. Buy.com was forced to abruptly alter the economic model and began to generate positive gross margins. However, the increase in pricing led to massive customer attrition and revenue falling 50% in 2001 and falling 20% in subsequent years. In trying to improve conditions, Buy.com sought to mimic the success of Amazon, introducing free shipping in 2002 and launching a major ad campaign offering 10% lower prices than Amazon. However, the value proposition was hollow other than price. Buy.com lacked a consistent vision and purpose and foundered coming out of the downturn. Amazon followed a very different path. As Amazon entered the downturn, the company cut excess fat from the company, laying off 1,300 people, or 15% of the workforce in 2001, and pretty quickly exited unprofitable escapades like Pets.com, Living.com, and Cosmo. Although I do have to say, I miss the days of having Ben & Jerry's delivered at my doorstep. Equally important, Bezos doubled down on the company's core competencies of customer service, continuous innovation, including things like search inside books, recommendation engines, and low price. Basically, he bet on the areas that were core to Amazon and jettisoned almost everything else. A couple of key lessons I think are worth highlighting. One, downturns accentuate business model differences, or in Warren Buffett's lexicon, you see who is swimming naked when the tide goes out. Second, focus on improving your core value proposition in tough times and get rid of the rest. And thirdly, trim fat in lean times. The last example is Salesforce.com and Siebel. In this case, the underdog ultimately proved more adept at navigating a down cycle. Going into the cycle, Siebel was the fastest growing enterprise software company in history going into 2000, but had significant vulnerabilities going into tougher times. First, Siebel had extremely low adoption rates and customer satisfaction, with approximately 60% of Siebel implementations either failing or not getting end-user adoption. Second, the company's pricing at several $1,000s per seat left it vulnerable to the lease model at less than $75 a month. And third, the sales strategy of elephant hunting in the Fortune 1000 accounts, which was perfect in a .com bubble-oriented spending environment, was the Achilles heel in a downturn. Salesforce.com, in turn, faced the daunting task of building a business in the midst of an economic meltdown, at the same time evangelizing a new architecture for delivering and using software. Benioff and team did several things exceptionally well. First, they absolutely nailed a sales and marketing message that spoke not only to the economic times, but frustration with Siebel and other client server-based software solutions, including low cost and pay-as-you-go style pricing. Ironically, the net present value of a retained customer on a subscription model is meaningfully higher than that of a customer on a perpetual license, and they nailed the message of low complexity and ease of use for business users, people actually operating and using the software on a daily basis. Additionally, the company exploited the innovator's dilemma to a T, with players like Siebel unable to readjust their financial model to the needs of more pay-as-you-go type models. The end result was that coming out of the downturn, CRM exploded in 2004 and is projected to be at the same revenue level in 2009 as Siebel was in 2005, having started at less than $10 million in 2000. Siebel obviously meandered for a few years coming out of the downturn and ultimately fell victim to that other software company in Redwood Shores. A couple key lessons stand out. One, low cost, shared risk selling message resonate in downturns. Secondly, pound your competitors' vulnerabilities in a down cycle. And third, stick to your knitting. Salesforce did not move outside of its bread and butter Salesforce automation until we were well out of the downturn. With my little pinch of reality complete, I will turn it back over to Doug.
Well, that was the good news of the day. I'm here to give the bad news. In the 35-year history of Sequoia Capital, we have never had a meeting like this, where we convened last Monday, and within 1 week's notice, we called in all the CEOs and we asked them to come here. And why do we do that? Because while we think that ups and downs come and go, we actually think this time it's very different. And we think it's going to be a very, very long recovery. Let me explain. The slides here talks about the flow of money into the venture industry. Let me share with you guys some secrets. A lot of venture firms made money in the late 90s. Every venture firm made money in the late 90s. Starting 2000 to 2005 or 6, very few venture firms made money. I'd say 1 out of 20, 1 out of 30. And in 2006, we saw the beginning of limited partners selling their venture interests to people further and further away from the United States. First in Europe, then in the Far East, and so on. Less sophisticated investors. In 2007, venture investors actually really slowed down their investments in the venture industry. And right now, very, very few venture firms are getting funded. And these are some of the quotes from a Fortune article just this week saying, looking for a new limited partner don't stop here. If you're a second-tier, third-tier firm, go home. There'll be a substantial miss in capital calls. That means they will not meet their capital calls into the venture firms into which they committed, which obviously crimps the flow of money that goes into your portfolio companies. If you're a startup and you're not cash flow positive, or you don't have a business model, you're in trouble. And it's going to be much, much harder to get another round. So those are the realities of the influx of capital. So the new realities, and there are companies here that have recently raised money with no revenues, $15 million rounds at 100 posts. I'll point out to you right now, there are public companies with nicely growing revenues and profits that are trading at less than $100 million valuation. There are growth equity companies that are very attractive whose valuation is less than $100 million. Series B's and C's are going to be way smaller because we all know how the game was played. We put $10 million on the cover, Series B's and C's came in, feeding frenzy, that $10 million became 15, 20, 25. That game is totally gone. Customers' uptake will be way slower. I think you look at September quarter, and whatever you experience in September quarter, you're going to experience something very different in the December quarter. Cuts are a must, and we'll talk a lot more about that. And there's a need to become cash flow positive to survive. There are other increased challenges. The number of M&As are going to decrease as will prices. Furthermore, acquiring companies are going to be interested in acquiring the lean companies, the companies with fewer headcounts, the companies that are cash flow positive. And of course, IPOs will take a long, long time. There's only been 2 tech IPOs in 2008. We had one of them, and no one expects an IPO for the last half of 2008, the last quarter 2008 and 2009. So there's a spectrum. You have to figure out where you are in that spectrum. My bet is that most of you guys are right here. There might be 1 or 2 companies over there that have rapid revenue growth, nice gross margin, profitable, a healthy balance sheet, who may want to take a different strategy. You may actually want to go out and get shares from your weakened competitors. But I bet most of you are right there. And in order to survive, you better have a must-have product. What's a must-have product? A product that increases a company's revenue, a product that meaningfully cuts expenses in hard dollars, a product that consumers really want. That is a must-have product. A must-have product is not a back-end product that a company might want to implement to marginally make them more productive. That is not a must-have product. So you have to look in the mirror and say to yourself, do we have a must-have product? Do we have an established revenue model? Meaning, can we ship something that has a gross margin associated with it? And can we do it over and over again? Let's really understand the market uptake. There's a number of you in the audience, a number of you vice president of sales, that I know have plans of hiring 5, 6, 7 new sales reps in Q4 08 and Q1 09. And by the way, I think salespeople and vice president of sales still have their heads down as they should without the global point of view. And I would urge a CEO to really, really pay careful attention to that. Make sure you're selling to customers who can pay the bills. That means no financial institutions for the time being. That means no startup companies who I think are going to batten down the hatches as much as anybody else. Have a true assessment against your competitors. You know, your competitors are going to suffer as much as you are. So it makes no sense to get into a feature war against your competitors who are going to be exactly in the same place. So figure out if you're stronger or weaker and make the necessary judgment, but realize that those competitors are boards as well, and they're going to make similar choices. Cash is absolutely king, and there's a need for profitability. So those of you that can get profitable, that are close to being profitable, get profitable as soon as possible. Now, sorry for being a little preachy here, but I'm going to go through a slide on operations review. Most companies, by definition, increase engineering headcount because you go from Rep 2 to Rep 3. You've got 19 engineers. Now you want to have 22. Now you want to have 25. And I would ask an opposite question. If you've got a product and you have to have incremental features of the product, you may want to consider decreasing engineering headcount for a change. What a novel thought. You want to figure out the product features that are absolutely necessary. We're all used to going from 3.0 to 4.0, more features. Sales guys come in. I've got 2 customers. They want that feature. Another sales guy says, I got that feature. Really, really scrub that because it is not a product features war, at least not for the next 12 to 18 months. Marketing. Many companies have VP of marketing, 3 product manager, customer marketing, product marketing, Marcom, and I would urge you to take a very, very deep look and figure out exactly what you need. Maybe you don't need a marketing department. I know there might be vice president of marketing here. I apologize. But I think survival is the name of the game for the next 2 or 3 years. I would really ask that question. What do we need in marketing? And whatever marketing does, can we measure it? Can we measure the success? Sales and business development. Some of you have a sales force. And some of you are thinking of increasing your sales force before the salesmen you have reached their productivity model. The productivity model for a salesman that's selling a $100,000 product is probably $2 million. And a number of you have salespeople that are $1 million to $5 million, $3 million, and are thinking of increasing your sales force by 5, 10, 15 people. And I would argue you don't want to do that. I'd argue you want to get the salesmen you have in the building productive to the full sales productivity model and then add incrementally so that you can save as much cash as possible, and you want to grow with the market because the market is not going to fly anyway. Pipeline. Scrub that pipeline because I know it's good intention. Your sales guys have good intentions. They're calling on companies with middle managers that are not being laid off yet, and I know what happens. Some middle manager, some company thinks he's got a budget, and guess what? The budget is not really there, at least not in Q4. That's just a reality of the next year or so. And last, look at your finance department. What's really necessary? Do you really need a VP of HR and a manager on their HR? Do you really need a CFO and a controller? Just be very, very careful as you look at all these lines. Let me introduce a new thought, the death spiral. The death spiral is like a black hole. If you're anywhere near it, it sucks you all the way in, and it has terrible traits. Trait 1, you're usually in it before you realize it. Trait 2, if you're in it, you can't get out of it. And trait 3, if you can't get out of it, it means you're going to die. Let me illustrate with an example. Here we have 2 companies. And by the way, this is most companies. Company A and Company B. Company A comes to the Sequoia meeting. And they said, holy cow, or maybe holy shit. And, you know, I get it. I'm going to decrease my growth rate. Not decrease headcount. I'm going to increase the growth rate. And they go up decreasing the growth rate, and 3-4 months go by. And then they said, boy, things are a little slow. I'm going to go into a hiring freeze. And then they say, man, we're really in trouble here. I'm going to make the first cut. And then they realize, oh boy, I think we're in a death spiral. I need to make a second cut. And by that point, it's too late. You're gone. And not argue, you were in a death spiral right there. Not right there when you thought you were. Maybe there, or maybe even there. Or maybe even that first step you made and not realizing that you should have made a cut put you in a death spiral. That's what I mean, that you're in a death spiral a lot faster than you think you are. Company 2 says, I get it. I'm going to make my cuts. And I'd argue, cut deeper than your wildest dreams. Cut deeper and be ready to rehire. Now, as I say that, there are always exceptions. Again, there are the companies that are moving up and to the right. Maybe they shouldn't cut. But by and large, I would suggest if you're going to cut deeper than you'd ever imagine, because that is what gives you the formula for survival over the longer run. And it's interesting because here's 5 great companies, and you would think, since they're the survivors, they're the ones that got it right. But look at operating expenses in 01 and 02 after the 2000 crash. They cut only to realize they didn't cut again. So they not only cut again, but they cut again even more. So those companies don't get it. Imagine what startups do. And I've been involved in companies where we did 4 or 5 pay cuts, where we, even as board members, get caught into not realizing how deep we should really be cutting. So you have a decision to make. What should I do now versus what do I wish I had done? Think of this. If you have 12 months of cash and you've got half your company, you have 24 months of cash. If you have 12 months of cash and you wait 9 months, it only buys you 3 more months. And I'd argue that once you do that, you've got a non-credible balance sheet that even though you've made cuts, customers are no longer willing to buy from you. And the excuses that we hear early on for the cuts, it's bad for morale, word is going to get around to my competitors are going to play it up in the market, I won't be able to get orders. Cut early, cut deep, and that's the only formula for survival for many of you. Here's a piece of email, and by the way, we received a number of those emails. The email came last night to Mike Moritz and me from another venture firm. Is this awful or what? My attitude is batten down the hatches. We need to have at least 1 year cash minimum in the bank. Raise funding as soon as possible. Pursue M&A opportunity. Be realistic in valuation. The VC community will start exercising leverage on you. This is a venture person in another firm, I've omitted his name, asking us, because I guess we're seen as the ones who survived 2000 best, what we should be doing. So there's no real solution, but here are some helpful facts. One is perform the situation analysis. Look at your pipeline, look at your company, and do it very, very quickly. Do it in the next week or so. Use a zero-based budgeting approach. Start with a clean sheet of paper and say, who needs to be in a company? There are no sacred cows. Who needs to be in a company? Make the cuts that are necessary as quickly as possible. Review salaries. Remember, eBay had a 10% layoff. Other firms are going to follow suit. There'll be pay cuts all across Silicon Valley. And I would suggest it starts with management, showing the way, and then it flows down to the rest of the organization. Employ a heavily commissioned sales structure. You know, we've gotten a little fat, and I know a lot of places where sales guys are hired at $100K, and they maybe have $100K a commission plan for a total of $200,000. My suggestion is bring the base down and commission them. Commission them heavily, but let them earn it through commission. Bolster your balance sheets as quickly as possible. Raise money, you know, add another 3, 4, 5 million in the next 30, 60 days. Become cash flow as soon as possible, and most importantly, spend every dollar as if it were your last. So you have a decision to make. You can get real. That means you can make the decision yourselves now and control your destiny, or you can get done, which means the decisions will be made for you by the market, not by us, Sequoia, but by the market at large in the next 9 to 12 months. And so my suggestion, again, there are always exceptions, but act as quickly as possible and make the right decisions for your company. I told you I'd be full of good news. I think we should go over there.
Hi, first question, Peter de Villiers from Clickertel. I think, Michael, you mentioned that this is a global phenomenon and not just the USA. If your company is pretty much exposed in emerging markets and you have software as a service type business models and your real investment is in the US market, is it safe to assume that the emerging markets and their influences are slightly a different nature, a different lag? Or is it really a question of, to Doug's point, when you look at your assessment of your business, cut and cut deep and you know, brace for the blizzard? So really, real question is emerging markets going to lag and ultimately face the same reality, or is the dynamics intrinsically different?
So 12 months ago, there was an underlying notion that we were going to have the great decoupling. America was going to get sick. Asia perhaps would feel some effect of it, but it would not be pronounced. And right now, we are seeing a lot of the BRICS countries slowing down in a material fashion. And granted, China may go from 11% growth to 8% growth. India may go from 10 to 7.5%. But those step functions down are pretty meaningful. So I think it is unrealistic to think that Asian economies or emerging economies are not going to feel the impact of this global credit crisis, the global drop in demand. And China has 45% of its GDP coming from exports. So they will feel the pain from the rest of the world. That said, the penetration levels for software as a service for a lot of technologies is remarkably lower. So I think the impact will be mitigated, but I think it's unrealistic to think that you won't see some impact in emerging markets as well. Dempster?
What's the prediction on how long?
I'd say when you're looking at this, no one knows the future. So, I mean, the first disclaimer is almost impossible to tell. And that's partly from the style of investing we do, which is endowment investing is very different. It's too hard to time the markets. You don't know what day of the week markets will go down, and it's almost impossible to catch a bottom. But if you're asking for an answer, I would suggest it's going to be more than 5 years. I think that the amount of rescue that is required, the amount of leverage that was imparted into this system, the failure of the derivatives insurance products, I truly hope I'm wrong. And by the way, things could be better tomorrow, but I think we're going to see some very strong bear market rallies. We'll see many head fakes. The cavalry will come, but it will, at least for the next few years, not be enough.
Here.
Really on the same topic of how long, given that we have this massive accumulation of debt overhang that some of the numbers suggest could take 10 years, 12 years to work off under a normal economic scenario, are there not possibilities then for a different scenario? So I heard the word reflation used, where because this is a global crisis and because in many nations political instability is a real possibility. We're talking about food shortages as a possibility. Is there not massive pressure on the governments to start printing money, inflate away the debt? We could even maintain the currency exchange rates if it were a coordinated action. Is there some possibility of that taking place where what finally remains is stuff, real assets that have real value? That's what we should be seeking to own today. Not currency, not T-bills, but hard assets, national resources, energy resources, high-quality equities, and so forth. Is there a reflation possibility through printing money?
A very interesting question, and the answer is I think yes. And I mean, I think in the end, you will have to inflate these debts away. They're just too large. And the question will just be whether the policymakers can do it. The good news is I think there's some very smart people at work here. And there's really a tremendous amount of attention on this issue, obviously, because it's screaming for it. To your question on productive assets, I mean, again, recognizing no one can predict the future, and you have to be prepared for anything, both with companies and investing along the lines of what Doug said. I think one of the risks in inflation, there are two huge risks in this reflation. One is you overinflate. So we saw this in the 20s with Germany. The Treaty of Versailles was just onerous, and so the debt levels were so crushing on Germany. They tried to print their way out of that problem. They tried to inflate their way, and this is the problem. It's very hard. How much do you inflate before you create Zimbabwe? It's just not that easy, because when you start putting on the printing presses, by the time you sense how to calibrate it, you may have gone too far. And if you've gone too slow, you can create a deflationary death spiral, which happened in Japan. They waited too long, and then everyone stopped buying because you could get things much cheaper next year. The second risk, not to just pile on the doom and gloom, but it's a real relevant issue that I personally think is what Paulson told Pelosi and Dodd and Schumer and those, that night when they all came to meet with Bernanke and Paulson, is that because more than half of the world's or the U.S. debt is in the hands of foreigners and we're so dependent on outside capital, there's a real risk of the dollar. In the near term, dollar's going up because all this debt is a synthetic short against the dollar. And as you de-lever and bring assets home and pay off debts, you're going to increase the demand for dollars. But long term, the dollar's at great risk. So when you look at areas where you've seen currency collapse, yes, having productive assets is a very important thing in the portfolio. So productive assets, I would agree. It's all about getting it at the right price. So at a minimum, I think this market shows you want to be diversified in your personal portfolio as much as you can across currencies, geographies, asset classes, because things will not be as correlated as they are now once things start to settle down.
Let me just intrude here a little bit. I'll reiterate what Eric said. We're trying to raise about $1 billion for a company at the moment. There is no place in the Western world that you can raise that money at the moment. All of our calls for this are outside of North America. Two other points. Jim Getz asked me to point out, and I think he's exactly right, one remarkable story from the last time that we ever had an encounter like this. And this is a gentleman called Dean Draco, who in the heart of darkness in 2000 started a company called Barracuda Networks and did all the sorts of unconventional things you do during dire times. And Dean, who is here today, now runs a company that has $70 million of cash, which is an extraordinary tribute to a very unconventional man who did things in a remarkable fashion. Now, I wanted to call on Mika Salmi, who is here. He's the gentleman that I alluded to at the beginning of the conversation, and I'll just ask him to tell in his own words what his company, come on up here, Mika, what his company looked like back after we had a smaller session like this some years ago, and then what he did and what would have happened had he not done it. And I'll excuse the fact that this afternoon, literally an hour ago, Mika's new company, Viacom, just served us with a subpoena.
Maybe that's why you put me in the spot today, because you just wanted to embarrass me from that. But I actually, I mean, maybe it's become rosier looking back at it, but I actually feel like it's much clearer cut this time around, the severity of this. I felt like in 2000, 2001, there was a lot of denial, and it was much more in one industry. It was just in the, obviously, the internet technology space, so it didn't have this kind of global phenomena. So I felt like there's a lot of denial. And, for us, I think Doug said it well, which was cutting deeper than you ever thought you would cut. And I think that's exactly was our philosophy, because my biggest worry when we realized we had to do something was that I wouldn't have much of a company to run because the morale would be so low. My mind was, if I have to do this, it's going to be really depressing to go to work every day. And so how do I make it less depressing? So how do I get beyond that? And so the solution wasn't those step cuts you saw there, which despite the wonderful board I had, that was the recommendation they gave me in the spring of 2001, was like, just start cutting now, cut every few weeks, avoid the WARN Act was this thing we were worried about, which if you cut over half your workforce, you have to give them 60 days severance. And so we were looking at that, but I thought, wow, that's going to be incredibly depressing. So we looked at it and we decided, Mike was saying we were over 300 people, and we were looking at kind of numbers of 50 to 80 people was our kind of debate, which we should cut down to. And we looked at it, and that looked reasonable because we actually had revenue and we thought we could make it through. But then it just had this revelation of like, it's going to be a lot easier to hire people, and everyone's going to go through something even worse than us potentially. So I want to go even farther. And so then we came up with, the number wasn't 35, it was 30. We called it the Dirty 30 was our nickname for it, because the people who were left we thought were kind of dirtied. And it was basically myself as a CEO and no one above director level. So I had no soldiers. I had no vice presidents, senior vice presidents, any of that. I went down to that level, but those are the people. Actually, I had no lieutenants. I had lots of soldiers. So that was, I think, the key thing we did was we just went down as far as we could go, which was 30, and we ended up actually, when it all kind of came said and done, we were at 32 was the number, and we were at 32 for a long time after that. But I think the key for me was that I really wanted my company to survive, and and I really thought about what kind of company did I want, and I wanted a company that was still a good place to work. And believe it or not, that drove me to go farther than we originally thought we were going to go. So we went down, instead of 50 or 80 was the other number, we went to 32. The reality was also that we were ahead of everyone else, so we had a lot to, we had a lot of runway ahead of us. People still had to go through all the cuts. So all the depressing news really started happening in the fall of 2001. We did this in June 2001. So I felt like by getting ahead of it, which I think is the message today, is if you get ahead of it a little bit and do it faster than anybody else does it, you actually will be in a better shape going long term. I think that was a good move on our part at the time.
Are there any other questions? There's a question right there.
Yeah, it's on. Hello. Yeah, Chris Barbin with Aperio. Obviously, we're going to all consider huge, dramatic changes over the next, couple of days. Are there any substantial changes, dramatic changes that Sequoia is going to make in your investment thesis, philosophies, new markets, or even markets that you're going to pull out of?
So, look, I think I think the one-liner is we're going to be very practical, and we're going to behave the same way you would behave if it were your money invested across all the portfolio companies. What does that really mean? That means that the companies that move quickly, the companies that preserve cash, the companies that we think have a real chance, the companies where the market has spoken or will have spoken and says, you have a chance to survive, those are going to be the companies that we're going to be more prone to fund. Let me give you the other side. The companies with very high burn rates, the companies where the market has spoken very loudly, and so have other investors, that said, we don't want to fund you anymore, those we're going to take a much harsher look.
Vlad Shmonis here with Ring Central. Question is about cash management, companies' cash in particular, and obviously with the banks folding left and right. What's the wisdom on that?
Please repeat them.
Sorry. What's the wisdom on cash management of companies' cash as far as reasonable places to keep what's left?
I think it's pretty obvious. I think you want to stay away from anything that seems like a shaky investment bank. And quite frankly, I wouldn't put it all in one place. I put it in multiple places. I probably wouldn't put it in places where you have debt. I wouldn't put it in places where you've got a lease line, because we've actually seen cash being frozen by the debt holder. And so I would recommend keep your debt in one place, put the cash in another place, and maybe don't put it all in one place. Just spread it out 2 or 3 places.
Hi, this is Nick Triantos from TalkBox. I can just make one quick comment in response to that. So we actually just went through, for what it's worth for other entrepreneurs, at E-Trade. We just put a bunch of money at E-Trade from a round that we had closed, and they set us up with a ladder of CDs that spread across something like 60 different banks. Each bank is individually insured by the FDIC. So unless the FDIC really does start defaulting big time, most of that money that we put in that ladder is pretty safe. And so anyway, that's just something to consider. And the nice thing about doing it at E-Trade was that E-Trade doesn't actually hold, they're not giving out any of those CDs. It's little banks like Bob's Bank in New Mexico and Joe's Bank in Texas. But unless all of them start defaulting and the FDIC can't cover all of them, that felt to me like at least one reasonably safe place to keep cash for some period of time.
I think we have time for 2 more questions.
I had my question, but I wonder if I can jump in. Dyke, you mentioned capital raise or raise funding. If there's real appetite from other firms out there to give a company funding at this time, maybe not acting as quickly or moving as fast as they should we take it and have those cash reserves to be able to then maybe pick up a bargain down the road, or at least preserve operations for longer?
I think if the question is if there were appetite from other firms, and let me add, even on not the most glorious valuation, that's my edit, whether you ought to take it. Right? Yeah, I think that this is a time to not get overly fancy. If you can get $5, $7, $10 million and do it quickly, I would grab it as fast as I could.
The mic. This is Greg Steiner from eHarmony. This is kind of bringing things back up to a macroeconomic question to those that follow the advertising markets. Is it surprising that there hasn't been a deeper correction in the amount of ad spending given kind of consumer levels and consumption levels? We're a big media buyer, and we're waiting for the correction to have more efficient media markets or more available and lower CPM rates, but the markets just don't seem to be correcting. And the graph that showed, a few percentage points drops in ad spending just doesn't seem to be a very deep correction given the circumstances of what's going on.
So one, I would expect some latency in the system. So as the economic and GDP deteriorates, you will start to see it soften across CPMs, et cetera. There really is a tight coupling globally with sort of advertising and GDP, and notwithstanding all the things that have led up to this, the U.S. economy grew in the first half of 2008. I don't think it's growing in the second half of 2008, and I don't think it's growing in 2009. So as this plays through a system, I do think you'll start to see pricing and advertising markets deteriorate further.
One last question back there.
On your charts that online advertising